When somebody asks you today what you do, what do you say?
Yeah, I mean, I typically say I'm a guy who did the venture-backed software thing, and then I bought a little place in West Virginia, a little cabin in the woods, and fast forward to today, West Virginia people, there you go. We've got a portfolio of a bunch of cabins and cottages. We raise capital from investors. We operate them as short-term rentals for cash yield. So I'm a vacation rental fund manager and a property manager. So in the weeds, doing turns all the time. And then I invest in a lot of search deals. So I put together a small fund. We've done 16 deals in the last 2 years. Met many of you guys through that. So I don't know, venture-backed software guy to SMB operator to investor. I mean, it's a mix. We can dig into all that, but that's the quick out of what I do.
When people ask me, I try to dodge the question by saying I just sit in front of a computer all day.
Yeah, basically. Yeah, if you ask my mom what I do, I play on the computer all day. If you ask my wife what I do, it's probably a similar answer, play on the computer all day. If you ask my kids what I do, it's kind of sad. Whenever we go out to a cabin, everybody's like, is this your home, Daddy? Is this where you live? It's like, no, it's not. That's not what I do. So it's a weird world.
But anyway. I get it. All right, so tell us about the business you co-founded with the best name I've ever heard, Contract Actually.
Yeah, it's Contactually. It's the worst name. The punchline is we were SaaS CRM for real estate brokerages and agents. So venture-backed business, grew that for 8 years. I was telling Sam earlier, it's one of those things where we thought we were clever. It was a CRM that helped you stay in touch with your contacts. So we're like, oh, Contactually, it's that anyone can say that. It's such an easy name. And it was the bane of our existence for 8 years. Like no one could ever pronounce it. It was auto-corrected to Contractually. People still say Contractually to this day, but it's like nails on a chalkboard to me, but it is what it is. But anyway, so it was a SaaS CRM business. Grew it to 10 million of ARR. Sold it in 2019 to Compass, big real estate brokerage. And so that sort of had the nice win, had the exit, and was sort of figuring out what was next. And that's what led me to sort of the SMB world.
So the question I get all the time from searchers is, what should I name my search fund? And they spend days and months trying to figure out what their name is. And I usually tell them, just don't worry about it. Go start searching. Call a broker. But I guess you do need to think about the name.
Yeah. Well, you don't need to, apparently. You could just, we had worse ideas. I think Contact Samurai was one of them, so that could have been it. I don't know. I'm a pretty I think one of the things we did well, there's like an ethos of my co-founders and I in our business. It was like, we're just gonna get shit done and we're gonna put it out there and see what happens. I think we weren't overthinking it. And so we always thought, well, Contactually, the domain was available, so we bought it, and maybe we'll change the name at some point. And we didn't, because of course it felt like when we were a year along and 2 years along, so many people know about us, it'll be so disastrous if we change the name. We're gonna lose all that brand equity we built. And then, it just gets, it's like, yeah, the 10 people who know us, they're really gonna shed a tear. And it just got worse though. Every year it was like, we gotta just drop this fucking name, and then we just never did. So 8 years in, yeah, it's stuck.
All right, so Compass calls and you exit. And you were pretty young, and you had to figure out what you were going to do next.
Yeah.
Why did you choose the SMB path that you chose?
Yeah, so initially I didn't have to, which is great. I've shared this with some of you guys. If you can sell to another software business and do the whole rest invest thing, it is ideal in all ways. So who's heard of resting investing? When I say that, this is not like a startup crew. Yeah, okay. So maybe a third of the group. Resting investing, when you sell a venture-backed business and you sell it to another software business, a lot of the time, not a whole lot's expected of you. You can rest and just vest whatever equity you're getting from that transaction out. And so that was the candid answer. It was cash deal, which was great, and then we had some equity upside. Compass was pre-IPO, so eventually the business did go through IPO. So my objective was, can I add value to the business? Can I continue to do something, but keep my effort minimal, to say the least? And that just gave me an opportunity to sort of figure out what was next. And to fast forward, my wife and I, we're big outdoors people. We always dreamed about owning a place in the woods, take our kids to. Bought that little place in West Virginia. I grew up in the Midwest, blue-collar family. I couldn't stand the idea of it just sitting there unused. So I was like, I can figure out the Airbnb thing. Let me put it on there. And it was doing super well. It's just printing cash. And so I went to my wife and I said, why don't we buy like a dozen of these cabins? we could do this, and this could be a new like cash flow thing. And my wife's an attorney. She's very conservative. She was like, pump the brakes. We're not going to be like a landlord of dozens of properties in West Virginia. I'm not buying a bunch of cabins. And so it like forced my hand to say, well, if I want to like figure this out, what would it take to form like a small fund to put some our money in, put some friends' money, and just buy these? So I ended up doing it, but sort of de-risked it for my wife. And that was the impetus behind Blue Maple. It was, this is going well, this little cabin we have. Let's just sort of rinse and repeat a dozen times over. That first fund, it was right before COVID, so it was a little bit of like, deer in the headlights. Everything shut down in like March, April of 2020. But it ended up being this huge, tailwind. There's a lot of guest demand. That first fund did really well, and so I ended up raising a second fund to do another 100 properties, and we're currently buying out of that. So it's sort of accidental. I don't know. I didn't expect I'd be like the, West Virginia and Virginia property management company. That wasn't like an aspiration, but it was sort of I think if there's one thing that drew that, like I like it in the weeds. I'm an operator. I think unlike the venture world, we can talk about some of the pros and cons. With Blue Maple, I own it. We didn't raise any capital. It was very profitable from day one, and it spits off a lot of cash flow. And it was like, oh, this is what like a real business can look like. That's actually profitable and growing and doing so organically versus relying on raising tens of millions of dollars. So it's just a different. I liked it. Is the short of it.
And I really want to ask about having sort of the committed fund money that buys properties and then the property management business to manage those properties. Yeah. Peter, you'd probably like that. Yep.
Yeah. There you go. Yeah, I don't know the long-term stuff, but short-term, I know all day long.
But I know Matt's probably texting me right now to say stay on time, so we should probably get to the topic of the day.
Yeah, sure.
So ultimately, you got into the business of investing in self-funded search deals. How did you do that, and what is Workbench?
Yeah, so to be more succinct about it, had this business, I kind of got into the nitty-gritty weeds of property management, started asking myself, I bet there are other businesses like that maybe you can invest in or build or buy. And you sort of ask myself the same question, like, I guess, like, what would it look like to invest in those deals? Because I'm in DC, because I was a tech guy, I knew Steve Ressler, also a DC tech guy. He was investing in search. He was like, have you heard of this search funder website? And so I would just got familiar. This was, 2-3 years ago. And a similar thought, like, I could do just one or two deals, or I could form a small fund and put bigger checks to work in a lot more deals, so diversify the risk across a bunch of investments, and that's what we've done. So Workbench, basically, it's a fund, a small fund that invests exclusively, or pretty much exclusively, in self-funded search. We've done 16 deals, typical checks like 150K, and we're just we've got a pretty clear sense of what we're trying to buy, but it's a similar, in a lot of ways, to the discipline of how we're trying to manage Blue Maple and all the principles of consistently profitable, strong growth engine, et cetera. It's like a similar thing we're looking for when we're investing.
All right, so too many speakers speak in generalities, so let's get into some dirty details. How much money did you raise for your fund?
For Workbench, $3 million.
$3 million. Yeah. What's your average check size is 150 grand.
$150K, yeah.
And this is in self-funded deals primarily.
Yeah, that's right. Yeah.
So what's your smallest and your biggest check you've written?
The first deal was $50K, and then it was sort of ramp. It was like $50, $75, $100. And then I was like, well, what am I doing? I'm going to have to do way more deals. So let's just do 150 over and over again. So we're just pretty much always doing 150 now.
All right. So maybe what's the average transaction size in those deals?
They're almost all SBA debt deals, right? So almost by definition, they're like $1 million to $2 million of EBITDA. They're heavily levered, 80-90%. So they're like $4 to $6 million transaction value.
And so of the total equity check, you are never the entire equity check. How much are you usually?
Yeah, we're never the entire. I mean, it's funny. It's a lot of search investors, they seem to care a lot about how much equity they actually own in the business. And I find that really striking. Right? You can't trip, assuming it's SBA debt, you can't trip 20% anyway. So you're going to be a small minority no matter what. So whether you're 2% or 4% or 6% or 10%, it doesn't really matter in my opinion. So I'm not trying to dodge the question. I just don't think of it that way. Our typical check's 150. The typical equity that's being raised is about maybe 500K-ish to $1 million. So we're we're a minority of the equity stack. And so we own probably like 5-ish% of any given deal, if I had to guess.
Is there a focus? Industries, geographies, searcher profiles?
Yeah, I mean, so to back up, there's like two types of, I think, search investors that I see, and we can talk about that if you guys have questions. There's traditional search, I think, tends to focus on, this is a business where we're going to be much more engaged. We're going to take a large position. We're going to own the majority of it. And we're going to go in and try to grow this thing super aggressively, even if it hasn't done that historically. And they're less levered in the process. It's the only way they can really achieve results because it's less levered. It has to grow really aggressively. I don't invest in those deals. I'm looking for sort of the opposite. Much smaller deal. I know I'm not going to have a lot of influence or ability to drive anything. I'm a small minority investor. So it's very heavily levered. We're sort of sharing in that leverage with the searcher. So we'll put in collectively as investors, 10%, 15% of the deal, and then we end up with 25, 30%, right? So we're stepping up. And so we're looking for something that's been consistently growing 5, 10% annually. Because it's levered, it allows us as the investors to still achieve that 30% plus IRR in a conservative base case. And we're not assuming any multiple expansion. So if we buy it for 4 or 5x, we're going to assume it's going to sell for that. That's pretty different from traditional as well, right? They're assuming they're buying something bigger, maybe getting it somewhat cheaper, or where they can grow it more aggressively and resell it at a higher multiple. So yeah, it's typically like these smaller deals, steady Eddie, wouldn't do like a turnaround, wouldn't do like assuming it's going to grow tremendously.
Yeah, they're almost, the way I think about it, mini LBOs, conservatively projected, not conservatively financed.
Yeah, exactly. And that's the point. I'm glad you mentioned about the not conservative finance. These deals are risky, right? They're extremely levered. You're eating a ton of the cash flow of paying the debt. And so there's just squirreliness that it's easy for me to say, I'm looking for something that's historically grown consistently, and let's just assume all of that's the same moving forward. But I see a lot of modeling from deals I'm looking at that like these base case assumptions are just
bullshit.
It's complete bullshit. And it's hard, it's easy for someone to see, if you're buying it for 4x, are you selling it for 4x in the model? That's a pretty easy thing to check. And like even your passive self-funded search investor that's doing like a deal a year can like pick up on that pretty easily. But the subtleties that I think trip people up, it's sort of like, someone mentioned it yesterday, you buy a business, the margin's not going to, EBITDA margin's not going to improve. Certainly not in the short term. It's going to drop. And so a lot of people assume, well, I'm going to come in and cut a lot of OpEx and make things more efficient. We're definitely going to do that from year one. I don't think that is not a very base case assumption. I think that's not conservative at all. You shouldn't be underwriting to that. I think a lot of people assume they're going to return a lot of cash to investors early on because the business is profitable. It's got cash flow. I'll give you cash early on. That's a way of inflating the IRR for the investors, right? Keeps the multiple return, the MOIC, relatively low. But like, I see a lot of people shopping deals like that or being coached and consulted to shop deals like that. They're just not that good at deals for the investor because you're making assumptions that are somewhat nuanced, so they're hard to catch that they're not conservative, but they're really not conservative. And I wouldn't assume them in the base case.
So how do you think about a search investment, an operator, a business, and the deal terms?
I'll try not to speak in platitudes, but I think what I do is not rocket science. It's sort of like, kind of see what works. I'm just trying to like match it every time. Operators, I prefer people who have actual operating experience versus deal experience. Because at the end of the day, the deal is going to be this short period of time, and you're going to operate for 5 to 10 years, right? So I think that matters a lot more, and especially in a business where I'm a small minority check, I want someone who I'm confident is going to like be calling the right shots and has been there, done that. Folks with military experience obviously typically have managed more blue-collar-esque teams. They're great. That's like a platitude, but I think there's a reason it's a platitude. So that's on like the operator side. On the business side, again, I sort of touched on some of these points already. Consistent growth, long track record, but not extreme. 5-10%. Obviously, profitable business, so not like something that's consuming all the EBITDA. I'm pretty industry agnostic, geo agnostic. I realized I didn't answer that earlier. I tend not to like stuff that's super cyclical. That's if it's tied heavily to construction. And that wouldn't be for me. But I've done some commercial roofing that's tied to more industrial, or you can see it's maybe a little less cyclical if it's got a reason why it's less. And that's something I would do. Trying to think if there's anything more on the business side that I'm not touching on. But then the deal terms, again, just to talk explicitly, I'm assuming that if the investors are coming in collectively with 10% of the equity, we're getting stepped up sort of 20%, 25%. So we're sharing in that in the leverage with you.
Who owns the rest?
And the searcher owns the rest. I mean,
So
like,
they're gonna own 70, 80% of the business.
And that's like, you gotta have comfort. It's akin to angel investing in the startup space, I think, right? When you're an angel investor, you're like, someone's raising maybe 10, 20%. They're keeping the rest as the founders. And the angels, sure, they have some influence. They're going to advise, they're going to help out. But they don't pretend to think that they have any real influence or a board position or something like that. And angel investing, I think, is very risky to do one-off. But if you do a portfolio approach, it can work. But it's, again, the nature of startup land is you've got one giant winner and then 9 fails out of 10, right? In this world, you still have this bell curve of distribution. You're still not going to, as long as you're diversified and you've done a pretty decent job of just trying to screen out, you can get a couple fails and you can get a lot that are sort of doing pretty well, and you get a few that are outstanding, and you drive sort of this 25, 30%, portfolio return. So anyway, that's how I think about it. But just lastly on the term, so there's the step up, a preferred return, so like 8 to 12% standard, and that's basically it. But I'd say again, when it doesn't make sense is when people really don't understand that dynamic of like the step up with investor equity. Again, if we're putting in 10% of the deal proceeds, I see people try to think the point of, well, you're putting in 10% of the deal proceeds, you should own 10% of the business. But I don't think it's recognizing the extreme risk of being 90% levered. And frankly, it's still a pretty great deal, I think, for the operator to own a whole business. You can put little to no money in yourself and end up with the vast majority of it. And I'm comfortable with that. A lot of traditional search investors blanch at that concept, but I think it can work, and it has worked.
Turnaround's okay or no?
No.
What about high growth small businesses? Okay?
If it's been doing it for 10 years plus, yeah. That's almost never the case.
But it always happens the year after close where revenue kicks up, right?
Yeah, I mean, look, I'm pretty conservative in my own underwriting. I've missed out on deals where that has happened. And at least it's happened for the last 2 years. We'll see if I think, again, I'm conservative in the underwriting, pretty clear of, I think, what I'm looking for. What doesn't mean that the stuff I don't invest is not quality. Great operators, great businesses, sometimes still great deal terms. It's just the level of risk I'm not comfortable with.
Domestic only or international as well?
I've done 2 in Canada. I'm looking at a deal in the UK right now. So those are the 3 countries I'll do: the US, Canada, and UK. There's someone else could speak to this probably more articulately than I can, but there are tax nuances to investing in Canada and the UK, but it's still, it's not super disadvantageous as a US investor. In other countries, I'm not knowledgeable enough, but I don't think it's, I haven't sought it out for what it's worth.
All right, before we turn it over to Q&A, we probably don't talk about the intangibles of being entrepreneurial business buyers enough. One of the ones I've been thinking a lot about lately is the support we have at home to do these crazy entrepreneurial things. For example, when I first was searching to buy what ended up being the dumpster business, my wife is a dentist. She was at home making a wage while I made nothing. And even to this day, it's still a challenge. We're sort of financially more secure, but now, there's PGs and there's the stress and volatility of the small business you own. What is home like for you? Your wife is a lawyer, is probably as conservative as mine.
Yep.
What's that like?
And we have 3 kids, 6 and under. My wife's a partner at a big law firm, so she's got way less time than I do. Luckily, I describe what I'm doing a lot of different things, but I've tried to design a life that gives me a lot of flexibility. So I'm pretty intentional. I don't work more than 40 hours a week. My laptop closes at 5:30. It doesn't open again until 7:30 the next day. And it doesn't open on the weekends. So I don't know. I mean, I'm giving you sort of just a quick gut reaction, but it's come up in a couple of different conversations the past couple of days, or just with friends in general. I've found that the time that I'm working on any sort of quote unquote business stuff today is far less than what it was 10 years ago. Probably at least 50% less. But the quality of that time, I think, and maybe I'm kidding myself, I think is higher. Like I'm forced to be much more efficient with my time and really try to be highly levered with my time. And so I'm like relentless about sort of prioritization and focus and ensuring that we're leveraging my team effectively to do that. But
Yeah, I was talking to a now owner yesterday about how we all as operators and entrepreneurs will just take all of the time given to work on our business, whether that's 30 hours a week or 80 hours a week.
yeah, totally. I mean, I think life's just too short, frankly. I mean, I have these moments that are like more philosophical every once in a while, where if an alien came to this planet and went into my house or any of our houses and saw us staring at this inanimate screen for hours, for all of our day, they would say, what prison are these people being kept in? It's like, it's such a, I mean, again, we just take a step back, it's kind of fucked up. And so I really try to keep that philosophy in mind at least a good chunk of the time. So I take off, a day every 3 weeks to just go in the woods, go for a hike, go kayaking, whatever. Again, I shared earlier about my hours. I try to I just try to make life is the focus, and my work is a component, but not the component of my life. And I think it's easy to sort of talk that talk. I think I'm largely walking that walk, or try to. So anyway, it was frankly, just to finish the thought, it was eye-opening for me. Selling my business, for me, filled like a giant chip on my shoulder. Obviously, it was nice financially as well, but it really, that's where it caused me to do this like life refocus or assessment on what really matters. And it was like a light bulb moment for me, like an eye-opening moment.
All right. Does anybody have any questions? John?
Yeah.
Yeah, cash flow questions around. Do we get cash flow from the businesses, or do we just have to wait till exit? It's about 50-50. So I've been at it for just over 2 years. So part of that is then what I just commented on earlier, right? There's not a lot of cash flow that we would even want the businesses to issue out. This is a little more nuanced. If you're investing in an LLC, right, there's phantom income. If the business is profitable and generating actual EBITDA, like I have a tax burden as a partner in that business if it's an LLC, so like we'll get money from that. That's standard. If you're not doing that or not planning to do that to your investors, it's really fucking them over because they're paying an actual tax bill for income that they're not receiving. So we're getting that cash. I would say a third of the businesses, yeah, they're definitely distributing cash, and then like significant amounts. Another 20% are paying their preferred in an actual cash dividend, but that's like 8%. And then maybe half-ish, we're not seeing anything today. And of those half, the bulk of them are intending to not do it until exit. And we're sort of fine with it. We're not looking for cash yield. We're looking for, it's a way to juice the IRR, but frankly, if we can get actual higher MOIC, like higher multiple of the cash, by holding it and reinvesting in the business, I'd probably prefer that. Yeah, I mean, that's sort of a weird part about self-funded, because you own the majority of it as the operator, you can operate it indefinitely. And there's real risk as an investor in that, especially as a fund investor. I don't want to be managing fund one for 15 years, right? Like, and so that's a natural question that comes up. And like what I look for is, what's your intention? Not that you need to necessarily resell the business, but what is my opportunity to exit the position in, say, 7 to 10 years? And that might mean you plan to resell the business. It might mean there are other investors in that business that would buy me out, and I'd want to talk to them and sort of understand their plans.
What I've seen too is the cost of capital has changed a ton. So to the extent there's free cash at the end of the year, a year ago, paying off that seller debt at 10% was an interesting use of money. Now, your SBA loan is at 11. Might as well pay that off. Your investors, maybe a year ago, or the pref was 7%. That was a nice rate. That could be 12 or 13 now. They want to take that money out quickly. So behavior's changed a little bit.
Yeah.
Over here, and just a quick reminder, when you do a question.
I don't know who that was.
Hi, this is Don Meyer. I'm from Austin, Texas. Two quick questions. How do you think about liquidity timeline? And then also, how do you think about owner's compensation?
Liquidity time, I think, so it's, again, that 7 to 10 years is when I'm looking to exit the position. And if we can get cash flow earlier than that, that's sort of like a nice thing. But really, it's the resale expectation that's going to drive the bulk of the return instead of 7 to 10 years for me. In terms of owner comp, the short answer is I don't care. I expect, again, from the philosophy of I'm a small, like minority investor, I'm explicitly backing operators who I trust in all sense of that word, right? Like you're going to run the business well, you're going to do things that are fair. Typically, I think the docs will state, what the comp can be, and I think if you're intending to increase it beyond X, you need to get approval. But like, honestly, when I see those docs come in, it's sort of like it's a administrative burden to like do anything. I'd rather you just do what you think is fair. I suppose if someone like was fucking me over and like, I'm going to pull $1 million a year salary out of the business, maybe I'd have a different attitude, but I just don't see that being a real risk.
I think about it in terms of levers. If a searcher really needs a higher comp for, their family, kids, that's okay. Tell us you need the higher cash comp, but you can't also pull a lever in terms of low pref to the investors and, pull the lever of trying to get the most equity. You sort of have to balance the levers you push and pull with your investor group. Michael?
Yeah. Yeah, it's a great question. The question was, the companies are not doing well. Why? Why aren't they doing well? Maybe would bucket it in 3 categories. There are things that 2 of them are largely out of their control, right? So sometimes the sellers are not honest. The business was actually shittier than they thought. There's one deal in particular that's the case where they're starting significantly in the hole, and so that's just an unfortunate reality of the business wasn't what he thought it was. Another, obviously, just with rising interest rates and just a looming recession, businesses that we thought were much more recession-proof, like they've seen a drop in revenue and EBITDA that was not really their fault. The business is probably okay long-term. It's certainly, there's no reason to think it won't be good long-term, but right now it's not performing well. Again, our intention is a 7 to 10 year hold, so that probably doesn't matter too much. And then there's just fuck-ups on the operator part, and that's, I think, can be fine. I think what I get most upset about or just frustrated with is when I'm not aware of it, right? The lack of communication or lack of seeking help in something's going awry. I think during one search and then certainly post, like minimum quarterly updates, and not like pages and pages, but just like a basic email of like, here are the highlights, here are the lowlights. Like that sounds, I'm like shocked that I have to say that, but it doesn't happen during the search, and it doesn't happen post-search from everybody. So I just think that if you're not doing that, this one deal in particular, but no updates, very uncommunicative, deals going sideways, trying to recapitalize now and raise more money. And I'm just like, yeah, thanks, but no thanks. There's no way I'm putting my money in this. And I think all the other investors are in the same boat. And it's unfortunate because I think that could have been avoided if he was just smarter about it. So I don't know, that's, again, I'm trying not to speak too generically, but that's the reason why they're to the left. I tend to think about like performance of the portfolio around, is this thing executing as we thought it would today, right? And that's what I just spoke to. Then there's what is my current belief on the long-term potential of the investment based on what we now know about the operator, about the industry, about the business, and then how communicative has been the operator. So how much intel do I really have? And I'm using all 3 to kind of assess.
Hey, good morning. To your left, Joe Hike from Omaha, Nebraska. Question I have is when I looked at funded searchers, there tends to be more things in place around governance that you can expect and that you'll see once the deal is done. When I look at self-funded deals as an investor, I don't see that. And so given the leverage profile and the other risk, it can be a bit concerning from an investor perspective of governance around that capital, how it's deployed, how it's used by the operator. What have you seen or recommend for investors to be thinking about when they're looking at these search fund deals where the governance is non-existent or maybe more or less?
Yeah, I think I take I know that my stance is different from most other people who invest in this space. And my stance is, again, it's so analogous in my mind to angel investing, which is let's not pretend like you have governance or real actually control over the operator when you have collectively as the equity investors a small minority position in the business. So instead, I'm very much over-indexing on assessing the operator and their trustworthiness and their ability to do things above board. And I'm encouraging them if I can be of value, or any of the investors in my group can be of value, think of us as advisors, put together at minimum, and in some sort of advisory board that you treat like a board, right? You may want to actually put together a board so people have some real incentive, right? You're paying them to some degree or whatever. You're giving maybe them warrants in the business. Like, I think that's smart. And I think a lot of people who seek out self-funded search, they do it for lots of reasons, but one of it is you can have way more control of the business, a way larger percent of the business, and you don't have a board breathing down your neck, all of which are good things. But I think it's being a penny wise and a pound foolish to not structure some sort of a vested interest board that will help support you, even if it's just an advisory board in practice.
And let's remember, in traditional search, the investors own the business and have hired an operator with carry to run that business.
Yeah.
That operator can be terminated and removed. I don't know how the SBA would look at it if a board could remove the guarantor from the business she is operating.
Yeah. I just wouldn't. Yeah. And actually, to that point, the PG is a nice governing device.
It is
right?
the best governing device.
It's like, just to unpack what I mean by that, like, you have a lot of incentive when you've got a personal guarantee on the debt. Like, it's rare, as Lisa and others would comment, that actually would come to like bite you in the ass. And it doesn't, hardly ever. But I do think it helps to ensure the business is not going to go away. Now, the slight disconnect there is things that may ensure the debt get paid may not be good for the investor, right? The business can still eke along and meet the debt obligation, but my investment's still going to zero. So there is a slight disconnect there.
Joe?
Can you talk a little bit about your fund, just review the dollars, the LPs?
Yeah, sure. Yeah, the question is, what's the fund look like in the structure and who's involved, et cetera? The fund's called Workbench Capital. There's about a dozen sort of investors in the fund. And I would say half are search investors that were doing, 1 or 2 deals a year, and found themselves in a position that I found myself initially, which is like, man, there's just a lot of inbound, and I don't have the time. I can't reasonably dedicate the time to do the underwriting and diligence. So they think about it as, I've been told explicitly, you're like my outsourced diligence, right? And I'm willing to pay for that. And then the other half are just, people from tech, other people that I know, high net worth folks that wanted access to the asset class to get, outsized returns. Fees are just a standard fund fees, 2 and 20. So it'd take like a 2% management fee, 20% carry on the upside. On a $3 million fund, the management fees, this sounds flippant, but it's $60K a year, right? It can't be a full-time job. And so by definition, it's like on the side of my desk thing. And then the carry is nice upside. But I like it. I try to, I'm a big LP in the fund. And it's a way, I think, to achieve what I wanted to invest, which was a very diversified pool. Yeah.
Kev, you want to handle it?
Lisa was going to make an important comment, and then we'll keep the Q&A going.
I'm sorry, I'm being mom again, making sure you have your lunch money before you head out in the morning. But I just wanted to remind people there are some SBA nuances around distributions. And just so, if you are putting a fund together as an investor, I would highly recommend you reach out to an SBA lender that knows how to work with investors and work within the rules of the SBA. There's that 20% threshold that was mentioned. And it's one thing in your cap table to have a certain ownership percentage, but then if you're baking in lots of stuff in the operating agreement where you're going to get paid, investors are going to also get paid $100K a year, and things are due and payable, and that's in your operating agreement, that also gets added to the inferred ownership, so the economic benefit. So it's not exactly Cowboy City, too. Although with SBA loans, one of the really interesting things for this room is there are no covenants. So that's also the other good thing. You don't have to ask your lender for a lot of permissions, but there are some nuances. And in the SBA docs, they don't speak to distributions. So you can pay distributions out to pay taxes, et cetera, and hopefully you're not over-distributing to the detriment of the company. We're kind of all assuming that that's the case, that everyone's going to have good self-management. So just reach out to lenders if you're going to be investors, just to make sure you fully understand how much you're allowed to get. And we're not taping this, so I'm going to say there's sort of on the record and off the record kind of stuff. I don't want to mention it in this big forum, but just seek out an SBA lender that knows how to work with investors, and you can talk sort of more candidly on that.
Good points. Surprise, we're taping it. We probably have time for one or two more, Kev.
Yeah, sounds good. Like a maze here.
Will from here in Austin. I had a question around for the operators or searchers that you back. Ideally, do you meet them before they've identified an acquisition target, or are you often seeing them with an LOI in hand bringing you a deal?
Yeah, good question. It's like 50-50, I would say, the deals we've done. Ideally, I'm meeting people early on in the search. You know, someone said to me like 10 years ago, investors love to invest in lines, not dots, meaning if the first time I've met you is when you have the deal in hand, it's somewhat hard for me to assess the trustworthiness, all the stuff I was saying earlier that I would like to know about you as an operator. But if we've built a relationship over some period of time and I've seen you've consistently sent those updates, you said what you said you did what you said you were going to do, that really goes a long way. So I think there's tremendous value in trying to build those relationships early on both sides. And frankly, because of the nature of the size of the deals, if you're only raising like 500K of equity and I'm trying to put 150K to work, there's just not a lot of room in the cap table. And so if I'm not meeting someone early on, it's like hard to get into smaller deals, which sometimes can have much better terms and be better. So it's like when you're buying a business, you would prefer to like, there's some value to having proprietary deal flow. Same thing in investor land. But then the reality is I've done a lot of deals. I know a lot of other investors who do deals. We share deals back and forth that are under contract. And if it's big enough, right, then I'm getting a call no matter what. So, I haven't seen, for what it's worth, like in terms of outcomes or quality of the businesses, I think the deal terms are slightly better when I maybe meet someone early on because it's a smaller deal. But I think the quality or performance seems to be similar either way.
One more here.
So Mark Schwartz, Austin. We talked about the downside case in some of your portfolio. Talk about the upside outside of quarterly updates. What in those are about the reaching out to ask for help has really worked well? What resonates with you?
Are you saying like what makes me think highly of the business, of the operator?
How could an operator communicate really well so you're really
Yeah.
comfortable what's happening outside of just the performance of the business?
Yeah, I mean, so I'm probably a little bit different in that most search investors are doing a couple of deals a year, right? And I think want to be more involved. Whether they're helpful or not is debatable, but they want to be more involved. Just the nature of doing like 10 deals a year, I just don't have the bandwidth. I'm never going to proactively be like, how utilize me, how can I help? So, but that said, if you have an ask, please put it out there because I'm also decently connected in my group and to lots of other operators. And so I try to be like the sort of node in the network that's just like pushing help out to others. So that's, again, I think just regular updates. Also, don't assume that I'm going to have continuity on the business or like know the depth like you do. And so like a refresher on like, this is what we do. This is like a consistent format of here's what we said we were going to do in terms of revenue growth. Here's what we did. I see a lot of updates that are like, here's what we did. And I don't have the context for, well, what were you going to do? Like, is that good? Is that bad? Like it's really hard. And that's probably a little more unique for me because I'm just spread across so many deals. But I think it's true of even if you're doing just one-off. And I think, candidly, it's an easy way for the operator to sort of mask when things are going poorly because they don't compare it to what the goal was. So yeah, as I think about it out loud, yeah, showing the comparison to goal is most helpful and just making the asks explicit, especially if they're intro-focused. That's probably where those asks can be the most helpful.
This has been great. Thanks, Tony.
Cool. Yeah, thanks, guys. If you do want to reach out, just Tony@workbenchcap.com. Happy to chat. Obviously, I'm doing a lot of deals, but also just like I love this community. So feel free to reach out. Thanks, guys.